Hi friends, it is a pleasure to provide you a glimpse into the year 2018 with regards to what it has in store for us from an Indian macro perspective as well as the fixed income market outlook. The Indian economy is highly correlated to the global growth inflation dynamics, hence a purview of what the globe has in store for us becomes imperative. With regards to global GDP growth, if you have a look at this map, economies which are likely to grow above their potential growth rate are marked in green. Hence, most of the advanced economies such as US, the European Union have better growth prospects. However, for an economy like India, the economy is expected to grow below the growth potential and hence marked in red. Improvement in global growth sentiment becomes evident if we have a look at the left-hand chart, which shows a long period average of global growth since the year 1980 to the year 2016. The average global output growth stood at around 2.8% year on year. For the year 2017 as well as the year 2018, global growth seems to be higher than 2.8%. Also, if you look at the chart on the right, which indicates the number of economies as a percentage of total economies which are having a PMI above 50, which means that they are in an expansion mode, has almost touched 95%. Talking now about global inflation, so while the global growth outlook is expected to be positive, with that comes some amount of inflation. For the emerging economies, controlling inflation has always been an issue, while the advanced economies are craving for inflation. Inflation prospects seem better for the advanced economies and the trajectory is headed northwards in the next 2 years. What is also crucial for the year ahead is if there is going to be any withdrawal in the liquidity infusion by the central banks globally. If you have a look at the global liquidity as a percentage of GDP, that has now kind of peaked at around 40%. The US Fed, which kind of started with the taper tantrum around 2013, the expansion in the balance sheet has more or less stabilized. However, the ECB as well as the Bank of Japan are still continuing with their buyback purchases and hence that kind of liquidity will continue. So concerns with regards to withdrawal from these central banks seem limited. Moving on now from how the global growth inflation dynamics are likely to pan out to where does India stand on the EME basket. If you have a look at the slide, it provides a snapshot of what the growth inflation dynamics are likely to be for the various emerging market economies and what are the policy projections. So if you have a look at certain economies such as Mexico, Russia and South Africa, for a foreign debt investor, these economies may seem lucrative because there is a scope for further rate easing. But however, if you consider their growth inflation dynamics, their growth is much lower than the projected inflation and hence that does not become very attractive. In fact, for economies such as Turkey and Brazil, the outlook remains cautious. But if you have a look at economies such as India and Indonesia, the growth inflation dynamics seem very positive. So while the growth is on an uptrend, inflation is pretty much under control, as well as the policy rates provide a significant amount of real rate return. Hence, for a foreign investor, these economies seem lucrative. Talking now about India's growth prospects, the year 2018 seems better on the growth front after the economy has taken 2 hits from demonetization as well as the uncertainty related to GST implementation. Things are likely to pan out in a favorable manner. Improvement in the global growth prospects is likely to provide a cushion for better export potential in the year ahead. Rural demand is likely to improve as well as medium-term productivity is likely to gain from the reforms that have been implemented so far. Reforms such as bank recapitalization, the GST implementation, the bankruptcy code all augur well for medium-term growth prospects for India. However, certain issues remain for the Indian economy, one being the very muted private capex cycle. Revival on that front still seems distant. Higher commodity prices are likely to be a drag on overall output as well as the expenditure side of GDP. Moving on into an election year, fiscal space remains limited and hence with regards to revenue as well as capex, the government has limited options. So for the fiscal year FY19, Indian GVA may likely expand by 7.2% vis-a-vis expectations of 6.2 to 6.3 this particular fiscal year. Moving on from growth, we now talk about inflation in the year FY19. For the year FY18, inflation at the CPI level is likely to average at around 3.6%. However, the trajectory is headed northwards in the year ahead. Concerns remain from the fact that food prices have reversed, the core inflation is very sticky and headed northwards, as well as the higher global commodity prices which have implied higher fuel domestic prices. With regards to that, as well as very adverse base effects which we had seen in the start of this year, where inflation numbers were as low as around 2%, provide a very adverse base in the first quarter and the first half next year. So average inflation for the first half could be somewhere around 5%, but that is likely to moderate going towards the fiscal year end. On the comforting side, we expect that since the economy is expected to grow below its potential growth rate, the output gap is likely to remain negative. In such a scenario, when the output gap remains negative, some amount of fiscal and monetary support does not tend to have inflationary impulses. The INR, which has been very healthy, will curb the imported inflation prices. For the full year FY19, CPI inflation on an average basis could be upwards of around 4.5%. The Achilles heel for the Indian economy has been the fiscal balances. The chart here indicates in orange the fiscal balances on a consolidated basis as a percentage to GDP for the year 2017, and marked in blue is for the year 2018. The small cubes indicate the average fiscal deficit to GDP between the year 2011 and 2015. So on a consolidated basis, if you have a look at the Indian economy, while we have marked some improvement between 2011 and 2015, where fiscal deficit averaged at around 7.5 to 8% to around 6% that we are seeing currently, however, on a consolidated basis, such levels still remain quite alarming. But most of the other economies plotted on the chart are actually showing deterioration from the year 2011 to 2015 as of currently. On the fiscal front, several factors remaining comforting. So the government is very conscious about fiscal consolidation. Every year the attempt has been to improve the revenue capital expenditure mix, as well as the intent has been to provide a very prudent budget. The disinvestments progress that we are seeing so far, in no particular year before this have we ever seen that the government is likely to achieve the disinvestment target. However, this year the government remains confident that that target of around 72,500 crore is likely to be achieved. However, the factors that lead to concern on the fiscal balances outnumber the factors that provide comfort. So like I mentioned, on an overall basis, a consolidated balance of 6% fiscal deficit to GDP still remains very elevated. With regards to tax collections, there is some amount of expectation that there will be a likely shortfall post the GST implementation. Again, with respect to the non-tax revenues, while the last few years provided a cushion from the spectrum sale of telecom auctions, this year we are likely to see a miss on that front. The higher oil prices act as a drag for the Indian fisc. If the higher crude oil prices are not passed on at the retail level, it implies an excise duty cut for the government, which means to that extent the government garners lesser revenues. For the year 2019, going into the election year, the government will have to ensure some amount of spending both on the revenue as well as the capex front. The improvement in the growth inflation dynamics for India on a structural basis has augured well for the performance of the currency. If we have a look at the behavior of INR vis-a-vis other emerging market currencies since 2014, marked in black is INR, where it has remained relatively steady compared to any other currency which has seen a lot of volatility. If we also talk about the long period depreciation bias that the INR has seen, for a 10-year period, it averaged around 4.5% on an annual basis. But if we move closer on a 5-year basis, that depreciation level declined to around 2.8%. Considering a 3-year window, the depreciation pressure on the currency was just about 2.6%. The steady macro has kind of reflected the lower depreciation biases through the years. In fact, for this particular year, the currency is on an appreciation bias. Looking at the INR not just from an absolute level, but also in terms of the volatility that it has seen post the global financial crisis, again marked in black is the INR, which has remained relatively steady and has marked very little volatility through the time frame. just about 2013, around the taper tantrum, is when the currency saw some volatility. However, if you compare it with any other emerging currency, whether it is the Russian ruble or the Mexican peso, which went for a toss around 2014, the INR has promised relatively stable returns. Thus, over a long period average, on a relative basis compared to other emerging currencies, the INR has delivered on lower volatilities. The slide here indicates the performance of INR in the years 2016-17 and what is expected from a consensus basis for the year 2018. Like we mentioned, the stable macro augurs well for the performance of the currency. The FDI flows into India are capable enough to fund the current account deficit, and hence with regards to that, external vulnerability remains limited, as well as the coordinated efforts from the RBI and the government have ensured a stable currency. For the year 2018, consensus states that there is no depreciation expected in the INR. We can expect some vulnerability from the policy normalization that is happening across the advanced economies, as well as going into the election year, some amount of populism that may emanate may lead to some inflationary pressures and some volatility for the INR. Slide here encapsulates what we have in store for us for the year fiscal 19, as well as the sensitivity that the Indian macro variables have with regards to oil price movement. Every $10 inch up for the crude oil prices directly impacts the headline CPI by around 60 to 70 basis points northwards. Since the weightage for fuel prices in the WPI basket is higher, that directly impacts the WPI headline by around 1.3 to 1.4%. With regards to growth, a $10 move shaves off roughly 15 basis points from the GDP growth estimates. Whereas on the external balances, the same kind of movement implies an upward trajectory of around 25 basis points. With regards to fiscal deficit to GDP ratio, an inch up in the oil prices by $10 increases the fiscal deficit to GDP by around 10 basis points. Our studies encapsulate these oil sensitivities. Hence, in a nutshell, CPI for the year FY19 is likely to be upwards of 4.5%. WPI is likely to be upwards of 3.5%. GVA growth is likely to move northwards to 7.2%. The external balances reflect a current account deficit of around 1.8% to the GDP, whereas the fiscal deficit is likely to see some slippage for the current year as well as the next year. Expectations hinge around 3.5% fiscal deficit to GDP for the year FY18 and around 3.2% for the year fiscal 19. So that was a brief snapshot of the Indian economy and what lies ahead in the year FY19. Thank you all for your time and attention. It would also be very interesting to have the fixed income market outlook by our head of fixed income, Mr. Amandeep Chopra.
Hello, welcome to our outlook for 2018 for the fixed income markets. So if you look at really the key drivers for fixed income markets, we have highlighted a few of them over here in this slide. The primary driver has clearly been the macro, and our outlook remains fairly positive for 2018. We expect the macros to be supportive for growth, which will also be somewhat supportive for inflation as well. However, our view on rupee on yields continues to be again positive, primarily driven by the improving macro for India. But the two key concerns for fixed income markets will remain the current level of policy rates in India as well as the global interest rate environment. We are expecting some degree of tightening from the Fed over 2018. We are also expecting the domestic central bank, Reserve Bank of India, to remain on an extended pause. So I think in this backdrop, if you really look at what's the key concern for local markets, they remain the following four. Firstly, the trajectory for oil, which will also influence the trajectory for inflation. Thirdly, the markets will be closely watching the level of fiscal deficit and the roadmap going ahead. And finally, we are also looking at some degree of volatility brought in about by the Federal Reserve Bank. So I think our views on oil, fiscal deficit and inflation trajectory has already been covered by Meghna. So what I'll really touch upon now is the fourth key concern, which is essentially the outlook for Federal Reserve rates. So this slide actually shows you how the Federal Reserve outlook in terms of their rate hiking cycle has really played out since 2015, when the first rate hike took place. So the chart on the left actually shows you how the Federal Reserve has actually continued to lower their guidance for the terminal rate both for 2018 end as well as 2019. What this essentially highlights is the fact that even the Federal Reserve is yet uncertain on the trajectory for both US inflation as well as growth, and hence their expectations on the level of tightening which is required has moderated. What's also important is that unlike previous cycles when Fed was hiking rates, if you look at the chart on the right, this actually talks about the pace of those rate hikes. So while the dot plot currently highlights 3 rate hikes for 2018 and possibly 2 for 2019, what's important is the pace at which the Federal Reserve seems to be tightening. So like I said, the right hand side chart actually shows you that the current level of tightening that the Federal Reserve has undertaken has been extremely gradual, and the orange line that you see on this right hand side actually shows that how slow the sequential rate hikes have been from the Federal Reserve. Now looking at what's really important for emerging markets is clearly the level of I would say policy rate cohesion that exists with the Federal Reserve rates. Now this slide actually shows you on a normalized scale how the policy rates have actually moved right after the global financial crisis. As you would notice, the line right at the bottom, actually the Fed rate, which as you would notice has fallen dramatically after 2007 and has continued to be fairly low till very recently when it started an upward trajectory. But what's really important over here is the white line, which actually highlights the RBI's repo rate, and this, as you would notice, has been sort of contrarian to what other central banks across emerging markets followed. So this actually did see a bit of a decline initially, but then it started increasing and has actually built up a fair amount of spread versus the Federal Reserve rate. Now this is important from our perspective of looking at the fixed income outlook, because one of the key concerns which investors typically have is that if Federal Reserve continues to hike rates, to what extent will other central banks really have to follow suit. For the next 2 slides, we will show how the local markets have behaved both in terms of the actual policy rate spreads as well as the 10-year yield spreads. Now this chart actually talks about the position of RBI's repo rate versus the Federal Reserve rate, and as again we highlighted in the earlier slide, the spread which exists presently clearly does highlight the fact that there is a sufficient amount of buffer available for RBI not to follow through with rate hike if let's say the Federal Reserve were to tighten. This slide again actually shows you the difference between the US 10-year and the Indian 10-year benchmark yields, and again like I mentioned earlier, you would notice here that the current spread does not in any way show that our markets are exuberant or are very expensive, given the fact that the spreads today are well upwards of 350 basis points. Finally, if you look at a study that we have undertaken in terms of correlations between the Indian 10-year and the US 10-year, also with the UK 10-year, what's really important over here is as you would notice from the chart here is that even prior to global financial crisis, the extent of correlation between the Indian 10-year and the developed markets 10-year benchmark yields was very low. Post global financial crisis, since we followed a slightly contrarian monetary policy, the correlation has actually turned negative, and it continues to be so whether you look at the US 10-year yields or whether you look at the UK 10-year yields. Now what's really important around this data point is, like I said, if you really expect the local bond yields in the US or UK to actually go up when the monetary policy tightening is being undertaken by their central banks, then clearly the 10-year benchmark yields will go up. But the comfort that investors will have by investing in Indian sovereign bonds is again, as highlighted in this slide, that possibly our yields need not go up or react to the same extent when the US 10-year yields are moving up. So let's now look at the local bond yields. So this chart actually shows you that over the last 7 years, Indian markets have actually seen 2 full rate cycles. So we actually had a period of rate hikes followed by a brief period of rate cuts, then again a reversal in the policy when we saw rate hikes, and then an extended period of easing by the central bank where we saw rates, the policy rates come down by almost 200 basis point. So now if you really look at these markets, we have highlighted in this slide what the average term premium spreads have been. Now a term premium spread essentially is nothing but the 10-year yield less the policy rate, which in this case is the repo rate. As you would notice in the periods of bearishness, when you saw significantly high number of rate hikes from the central bank, the average term premium spreads have been close to 200 basis point. When the markets were rallying, the term premium spreads have been actually as low as 30 basis point, and over the recent past, when we actually had a fairly elongated easing cycle beginning in 2015, we've seen actually the term premium spreads just around 50 basis point. So from our perspective, when we look at the current yields on the 10-year benchmark, clearly a spread of 120 basis point over the policy rate does not indicate a markets being very expensive. Now this is very important because clearly a term premium spread of 120 basis point does tend to price in a lot of uncertainties and a lot of risk factors for local rates. So at 120 basis point, we think that most of the negatives that are there in the markets today are already priced in. So when you look at 2018, we expect that these kind of term premium spreads are not sustainable unless some of the risks that we have highlighted actually play out over 2018. So if you look at this chart, this actually shows you what the real policy rates are vis-a-vis the inflation trajectory right now. Now the blue box highlights the spread being between 100 to 200 basis point, and the red line actually shows where we are presently. Now with an inflation print which is likely to go up to 4.5% over the next year, even if RBI were not to touch the repo rate at 6%, it does still offer you 150 basis point of real interest rate spread. Now this is relevant clearly because if you actually have inflation not exceeding the current expectation of 4.5 to 5%, then I think there is sufficient reason for RBI not to hike rates going forward. So what are the swap markets really indicating for fixed income rates? Now if you really look at this slide, this actually shows where the 5-year OIS yields, and at the same time both onshore and offshore 1-year OIS yields are. So if you look at the swap rates, clearly they are indicating some degree of tightening from the central bank. Historically, if you looked at this chart, the 5-year swap rates have generally been barely 10 to 15 basis point over the policy rate. But over the recent past, you've actually seen the spreads balloon out to almost 63 basis point. Now this does indicate a fair amount of bearishness in terms of market expectations. They are pricing in maybe one rate hike from the central bank, at the same time are pricing in a lot of concerns around the 4 key uncertainties that we talked about. Again, if you really look at how the 10-year yields have moved for the calendar year, the blue line actually shows you the 10-year yield movement since beginning of 2017. And what's really important over here is, just to give this a perspective, in 2013 when we actually saw 3 rate hikes from central bank and you saw a lot of concerns post the taper tantrum with yields hardening across the world as well as a lot of currencies reacting very violently, the 10-year yield actually corrected by almost 93 basis point. In the current year, the yields have actually already moved up by over 80 basis point. So clearly, in an environment where RBI has continued to highlight its neutral stance, and at the same time given the inflation trajectory, we are not expecting any meaningful tightening from RBI, clearly such a level of movement in the 10-year yields does point towards a lot of concerns and a lot of risks being already priced in. So in this backdrop, what is our outlook for the 10-year yields over 2018? We think the 10-year yields will more or less be somewhat range bound but with an upward bias. Like I highlighted, while there are 4 key concerns for fixed income markets, we think at the current level most of these risks are already priced in. So we do not see any significant upward move. However, the bands that we think the 10-year yields can move over the next 1-year period would be between 7 to 740. And as this slide actually shows you, while we expect the RBI to actually remain in a status quo mode over 2018, we do not expect any rate hikes from the central bank right now. But the 10-year yield, given the level of uncertainty and news flow around these 4 triggers, will be range bound between 7 and 740. This is again for the current 10-year. The new 10-year would possibly be priced 15 basis point lower than this. So, the new 10-year when it comes into the market could trade between 6.85 to 7 quarter. So, just to summarize our outlook for 2018, while there are concerns around the Federal Reserve tightening its balance sheet, we think the level of easing as well as balance sheet expansion from the ECB and the Japanese Central Bank will offset any tightening by the Federal Reserve. So, from a global liquidity perspective, we continue to believe that 2018 global liquidity will remain supportive. Secondly, if you look at the rupee outlook, like we mentioned earlier, we continue to remain positive on rupee, both from fundamental aspect as well as on flow basis. Finally, if you look at budget, we are looking at some degree of fiscal consolidation. Clearly for FY18 there would be some degree of fiscal slippage, but for the following year we do expect the government to actually return back to the fiscal consolidation path. So, the recent FOMC meeting did not throw up any negative surprises for the markets. The Federal Reserve has continued to highlight status quo as far as their rate hikes for 2018 are concerned. So, the markets are pricing in 3 rate hikes for 2018. Finally, for domestic liquidity, we expect liquidity to actually turn somewhat neutral only in the middle of 2018. So, that should remain supportive for local bond yields. So, on the other hand, if you really look at key concerns, the biggest one continues to be higher global growth could actually lead to higher commodity prices, which would clearly be some inflationary for India. Secondly, the domestic inflation trajectory continues to be upward given the fact that there is a base effect which will kick in, as well as the current momentum of price increases does point towards higher inflation trajectory. So, in terms of supply of bonds, there are concerns around supply side pressures driven by the recapitalization bonds, which could take away some appetite for government bonds by the banking system. Also followed through with the question mark around fiscal consolidation in 2018. Now, since we are heading into an election year, there are concerns on whether the government can actually undertake continued fiscal consolidation. Finally, there are always concerns around global events which can trigger a lot of volatility and emerging market outflows, which could actually pose a risk both for currency as well as local rates. So, as you can make out, given our outlook, the positives and negatives more or less balance each other out, and I think in this backdrop it will be difficult for markets to take a very strong bullish or bearish view going in. So, if you look at performance of fixed income products within the mutual funds, we have highlighted 2 key product categories here. The blue line talks of the long duration bond fund category as represented by the CRISIL bond fund index, and the orange line actually shows you the performance of the short term fund category, again represented by the CRISIL short term bond fund index. Now, what you would notice over here is that on a 1-year basis, the rolling return profile has generally been very supportive for the short term category. Now, this has been more or less range bound, and we have seen a lot of volatility and risk events over the last 5 years. So, clearly from a 1-year perspective, on a risk adjusted basis, the short term income category does provide you a more stable, steady return profile. So, again, if you looked at the same chart over a 3-year period, as you would notice in this slide, the return profile even of a longer duration fund like the bond fund actually improves significantly. So, the lowest return that you would have got over a 3-year period in since last 5 years would have been just over 6%, but the highest would have been actually upwards of 13%. Now, this does highlight what we have always been saying, that if you do invest in longer duration funds, you need to have a proportionately longer investment period. So, if as an investor you are looking at low volatility of your funds, then the short term income category does provide you that investment option. Thank you for your time today, and I hope you found this presentation useful.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.